Welcome back to another video. So in this video, I want to talk about the deferred tax on expected credit losses, or the allowance for doubtful debts as it's commonly known. This is a topic that seems to confuse a lot of students, and I think that it has to do with not properly understanding what the tax provisions say about this. As I always say, the problem is not deferred tax, the problem is tax. So we've got to make sure that we understand the tax implications in order to then figure out how the deferred tax works. So let's look at just a simple example. I'm just going to make up some numbers, right? So let's imagine that last year we had an opening balance for our allowance for expected credit losses. Let's just say it's 50. And this year the closing balance is 60. Okay, so from that we can see that there was 10, a movement of 10, and that was the bad debts expense that would have gone to profit or loss. So if we are doing our current tax calculation, so if you think of profit before tax and you are trying to make the adjustment to get it to the taxable income, okay, in your starting point you would have your profit before tax, which includes that bad debts expense. So what you would then do is you are going to reverse that bad debts expense. So you would have to add back the 10 for the bad debts. Okay, for the bad debts. Now all that adjustment does is it takes out what you've already done from an accounting perspective, but then you've got to now do your own adjustments. So the way that the credit losses work is that you get a 25% deduction on your closing balance. So the closing balance over here is 60, and so our 25% on that would be 15. Oops, what happened there? 15. Okay, so then we are going to, in terms of 11J, we're going to claim a deduction for 15. Okay, but we have to remember that part of the way the deduction works is that last year's balance has to be added back. So we will then add back the deduction that we got last year, which was the 12.5. And from a current tax perspective, then that is how it would work. So if you just think of sort of a timeline of how this works, is every year, if these are the different years of assessment we're dealing with, every year we are claiming 25%, and then the following year we add back 25% of the balance and so forth. Okay, so that's how the allowance works practically from a current tax perspective. Okay, but what does this mean for deferred tax? So if I am looking at my allowance for doubtful debts, okay, and I'm thinking about the carrying amount. So the carrying amount over here is going to be the closing balance of 60. Okay, so I put that over there and I put it in brackets because it's a credit balance. Then I've got to think about my tax base. Now, because this is it's a credit balance, we're going to use the rule that we would for a liability, right? So for a liability, the tax base is its carrying amount minus future deductions. So we've got to figure out what are the future deductions. Okay, so going back to this timeline I have over here, okay? In the current year, so we are standing over here at the end of the year, right? So we're standing there, so up here, and we have already claimed a 25% deduction. But in the future, if these debtors are going to go bad, what's going to happen is we are going to be able to claim 100% of the bad debt when it actually goes bad in the future. But we've also got to take into account that we would have added back the 25% that we were granted in the current year. So on a net basis, our future deductions, right, would equal 75%. Okay, so in that case, if we are looking at the tax base being the current amount minus the future deductions, then essentially the tax base becomes 25% of what the carrying amount is. So our tax base then becomes 15, and that will give us a temporary difference of 45. It's a deductible temporary difference because we expect to pay less tax in the future. Now, just think about this again for a minute, this 15 over here, right? When we think about a tax base, we say that it is the amount attributed to an asset or liability for tax purposes. Meaning, if the tax authority were to prepare your statement of financial position, what do they think your allowance for doubtful debts is? And because the tax authorities, or SARS in this case, is only allowing you to deduct 25% of your expected credit losses, that means that you or from their perspective, they think that your allowance for doubtful debts is actually 25% of what you've recognized. And so that brings us back to this 15 over here, right? This is what they think the expected credit losses are worth. And so that is exactly the tax base that we were able to get to by deriving those rules. But again, I say, right, it's important to understand why that is the tax base, right? We're using the rules for liability, and what this whole thing hinges on us understanding that at the end of the year, even though we get 25% as a deduction now, we have to add it back in the following year. But if those debtors go bad, we are able to claim 100%. And so that is why we have that tax base equal to 25%, and it's going to give rise to a deductible temporary difference. Thanks for watching, and I'll see you in the next video.